So we're talking about almost $5 trillion worth of stimulus packages that were passed between March 2020 and March 2021 to help stimulate the economy. And this doesn't include all the money that the Fed printed to bail out the stock market. So the United States government passes like $5 trillion worth of stimulus aid. That way they can send this money out into the economy in the form of stimulus checks and grants and bailouts and other financial aid from the government. But the thing that you have to understand here is the government didn't have $5 trillion sitting in a vault somewhere. I mean, the United States government is drowning in debt. And so to fund the stimulus, the United States government has to work with the Federal Reserve Bank, who then prints this $5 trillion. And then the Federal Reserve Bank loans this money to the government. They give it to the government, but then the government has to pay it back plus interest. And then the government now has this cash that they can inject into the economy through the form of stimulus checks and grants and bailouts and other financial aid. Now, to really understand the cost of what's going on, let's take a step back away from the government, away from the dollar, away from money printing, and let's think about starting a company. Let's assume that I am starting a mustache wax company, and I'm starting this company with 3 other partners. So I'm going to represent the ownership of this company with this bar, and I'm going to assume that I own 200 shares of the company. So this is me right here, and my cousin, let's call him Bunty. He owns 200 shares of the company, and then person, let's call it A, owns 200 shares of the company, and then person C also owns 200 shares of the company. So right now, all 4 of us owners are equal owners. Each one of us own 25% of the company, and we all share in the profits of the company, 25, 25, 25, and 25. Now, if I wanted to go out and raise money, and I wanted to use this money to help grow the company, I could bring in another investor. I'll put this in red. So I'll call this person I. So I might go onto Shark Tank and say, all right, I'm going to sell 20% of my company for $10,000. So I go onto Shark Tank and I find this investor I, and I want to sell them 20% of my company. Well, in order for me to give them 20% of this company, where is this equity, these shares going to come from? One option is all of us can give this I some of our shares, but what you more commonly see happen is instead of people giving this person their shares, more shares are created. And so in this case, I might get 200 shares, which are now created essentially out of thin air. So when this happens, I gets now 20% of the company. They get 200 shares, and now all 4 of us had our ownership diluted. Before, I owned 25% of the company because I was one of the 4 owners who owned 200 shares each, but now I'm one of the 5 owners who owns 200 shares each, which means I'm now 20% owner of the company. So my ownership was just diluted, and if I want to maintain my ownership structure, if I want to keep being a 25% owner, then I'm going to have to use more of my money to buy more shares of the company. So maybe you have to come in here and buy another 50 or 100 shares of the company. That way I can maintain a higher ownership structure. So as more shares are created, the original owners are now diluted in their ownership unless you go out and buy more shares, because when more investors come in, more shares have to be created. The whole idea behind me doing this as an entrepreneur here is I get to use this investor's cash. That way our company has more cash that we can invest. And let's just say that when this investor came in, our company was worth, I forgot what I said earlier, but let's just say it was worth $50,000. My goal now is to use this cash to get more sales, to get more profits, and maybe one day this company will be worth $500,000 or $1 million. So my goal is to make the company more valuable by creating more value through the company. The thing that I want you to remember is that as more shares are created in this company, the original shareholders get their ownership diluted unless they go out and they buy more shares, unless they accumulate more shares. In the economy, we see something very similar happen, because now as more and more money is printed, it's essentially like creating more shares. And so what happens is the value of your dollar gets diluted. Here, your value of ownership got diluted, but now in the economic system, the value of your dollars get diluted because each dollar that you have now doesn't have as much buying power, and it doesn't stretch as far just because we have so many more dollars in circulation. This is what inflation is. So when you get a stimulus check or when a company gets a bailout, it's good temporarily because maybe you got some extra cash that you can go out to spend with right now, but over the long term, this has a very expensive consequence because over the long term, the value of our dollars get diluted, which means each dollar that you have saved doesn't have as much buying power, and each dollar that you're working to earn doesn't stretch as far. But it's not just the money printing that causes inflation. Lower interest rates causes inflation too, because when you see lower interest rates, what that causes is more money gets printed. Because when more people are going to the bank to borrow money, more money gets created through banks, through the Federal Reserve Bank, because when banks don't have enough money, they go to the Federal Reserve Bank to borrow more money, and the Federal Reserve Bank creates this money. So as interest rates go lower, more people go out to borrow money. They might go out and get another mortgage, they might go buy another car, they go put more money in their credit card. So more people are borrowing more money from banks, which means banks go to the Federal Reserve Bank, which makes more money created. And so as more money is created here and more money is created here, more inflation happens, which is interestingly exactly what the Federal Reserve Bank wants. Now, I should also mention that while inflation causes your cost of living to go up, it causes your rent to go up, it causes your grocery prices to go up, it causes your vacations to become more expensive, it also is supposed to make your wages go up. But what we've seen happen over time is that yes, while wages do go up with inflation, it doesn't usually keep up with our cost of living and our standard of living. So as more inflation happens, you're going to see things become more expensive. And yeah, while your wages might go up a little bit, it doesn't keep up with the rising cost of living. The most obvious losers here are the people that are just saving all of their money because their savings are getting eaten away by inflation. And it's also the people that are not financially educated, because when you're not financially educated, you're falling into the traps of just going deeper into debt to finance a whole bunch of things that don't make you any money, while the financially educated and the wealthy are now using this system to buy more assets, to buy more investments that are growing with inflation. So you're seeing the rich get richer and the poor get poorer. This again is why financial education is so important. And if you haven't read our free money management PDF, I'll put the link to where you can download it for free in the description below. But the interesting thing about this is MarketWatch has kind of made it apparent that this higher inflation is also bad for people nearing retirement. Essentially what this article says is that the people that are hit the hardest by higher inflation are none other than people that are entering retirement, because when you are entering retirement, the whole idea is you invest your money into things like stocks, but as you get closer to retirement, you're moving money out of stocks into safer investments like bonds and bank CDs and things that give you kind of more fixed income, because you want something more stable that you can rely on. That way, if a market crash happens, your entire retirement is not dependent on this market crash. And so if you are nearing retirement, you kind of move your money towards these safer investments. And so if you're in these fixed return investments as a retiree, now the amount of money you're going to be making every single year is flat. But if you have higher inflation, then the cost of everything keeps going up and up and up. So you're not making any more money, but the cost of living keeps going up, which is why it becomes harder and harder for people that are in retirement or near retirement to be able to survive. The reason why this author, Brett Arends, is worried is because inflation is ramping up. He says that before the election happened, before the 2020 election, inflation was right around 1.6%. Now, just a few months after the election, it's at 2.3%. That might not seem like a super drastic increase in inflation, but that's a 40% jump in inflation in just a few months. The other thing that I want to mention about this 2.3% number is that it's really just an average. That's not the real inflation rate that a lot of people are feeling, because we have a whole generation of people that, yeah, might be facing this 2.5% inflation, but they can't afford housing. They can't afford their groceries. They can't afford basic living, because real inflation is way more than 2.5% a year. But sticking with this article, essentially what it's saying is that we have all these people in retirement or near retirement that have these fixed return assets, and they're going to be the ones paying the price, because the cost of living is going to keep going up and they're not going to be making any more money. So he's essentially saying that you need to be financially educated and move your money into places that are going to grow with inflation, because the cost of living is probably going to be a lot more in the future. Just like how $1 in 1970 was worth way more than $1 today, well, $1 today is going to be worth way more than $1 in 2050. So the whole issue in a nutshell is we have this recession, and to combat this recession, we're seeing lower interest rates and all this money printing, which causes high inflation, which is expensive not just for retirees, but everybody who is not financially educated. Retirees are going to pay the most apparent price right now, because a lot of retirees have this fixed income where the amount of money they make every single year isn't changing, but at the same time, the cost of living is going to keep going up. And for younger people, if you're not financially educated and you're saving all of your money, or your income is not growing, then you're also going to be paying the price, because now, well, everybody else is going to be richer. The cost of living is going to go up, while while you continue to become poorer. Lucky for you, I do have a solution. The first solution is, if you haven't already, make sure you subscribe to our YouTube channel because we release financial education videos every single week. But something a little bit more practical for your money is, now you gotta understand what's going on, which we have just talked about. But second, you need to take your money and put it in places that are gonna grow with or faster than inflation. That way you can kind of combat this new inflation that's happening. There's a few different ways that you can beat inflation. Now, this is a big argument and debate on Wall Street as to what is the safest way to beat inflation, because everything has their own risks. And I'm going to go over all of these. So one of them is tips, gold, real estate, stocks, cryptocurrency, and businesses. Let's start with tips. Tips are treasury inflation protected securities, and these are literally just investments that grow with inflation. So you would buy tips if you just want your money to grow with inflation. The whole idea being that you put your money here so that when inflation happens, your money will grow with inflation. You're not going to see your money grow faster than inflation. It is just kind of a hedge against inflation, because as inflation happens, your money is supposed to grow with inflation in this investment. So if you're just worried about the value of the dollar dropping and you don't really care about creating more value with your money and producing more money through that more value, then tips might be a way to go. Gold, on the other hand, is a commodity. So gold, if you invest in physical gold, you own something tangible, physical, that you can see, feel, and touch. And there's a limited supply of gold in the world, and gold does have some practical uses. The whole idea here is that gold is supposed to be a hedge against inflation, because there's a limited supply of gold in the world, but there's not a limited supply of dollars. So as more money or dollars are printed, then the cost of gold will go up because the value of your dollars will drop. But the thing about gold is, again, gold doesn't produce any more value. If you buy a gold bar and you put it in a vault, it just sits there and stares back at you. It doesn't produce any more value. So your goal here, again, is just to kind of meet or match inflation, because gold is supposed to be a hedge against inflation. The next option is real estate. And when I talk about real estate, I mean real estate as an investment, owning rental properties. When you buy real estate as an investment, again, you own something that you can see, feel, and touch, but now you own something that's going to produce value, because if you buy a home, then this home produces value to somebody else, a family, because this family can live in your home, and they might be paying you $1,500 a month to live in your home. Now, the interesting thing here is, as more inflation happens and rental prices go up, well, your rent might go from $1,500 a month to $1,700 a month. So as more inflation happens, yeah, you're going to see your expenses and your taxes and your insurance might go up a little bit. But at the same time, to kind of combat that, your rent would also go up as well. And so you would be benefiting from this high inflation, because your rental prices would go up. And if you are buying your property in a good area where there's more demand and more money is flowing, then the property value would also be going up. So not only would you see growing rental prices, but you'd also be seeing appreciation in property values. Next is stocks, because when you take your money and you put it in stocks, now you are buying shares of companies that are now benefiting from inflation. Because if Lululemon has to charge now $500 for a pair of leggings instead of $200, well, now you are going to be on the beneficiary of this, because now your company that you invested in, assuming you invested in Lululemon here, is going to show bigger revenues and bigger profits just because the dollar figure of their products has gone up. And so you now, as the owner of this company, would be on the beneficiary side, because as more inflation happens, you're going to see the prices of products being sold go up. And if that happens too, asset prices like stock prices would also go up. And so you can be on the beneficiary side of that by owning stocks. Now, this is where things get a little bit tricky, because people at the same time are also worried about market crashes. And so you have this kind of risk of higher inflation. But what if stock prices crash, or what if real estate prices crash? Because that is a concern. Well, there's no perfect answer here, because it's impossible to predict when a crash is going to happen. And the best thing to do when a crash happens is to have some cash on the side and use this cash to come in and buy aggressively, because when asset prices crash, well, then you can come in and buy these assets at a discounted price.